Hello and welcome to the Monday Futures Market Outlook for August 27, 2012. This is Patrick Sresna. For those of you that have not had the opportunity to try out eminisource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the U.S. dollar index futures, and we see a market that more or less has found support along the 81 and a quarter area where all the highs occurred during February and March, as well as a low back in June. This support line right here created initially a bounce. It's very common for after a little bounce like that for the market to come back and retest that. So anticipating at some point here for some further testing of those zones. But this also represents a very good risk reward proposition to actually own the US dollar, because if the primary uptrend remains intact, this is roughly the zones where the US dollar would find support. So you would be accumulating on a pullback in a key zone. Equally, if it broke substantially below 81 with any further follow through on the downside, it would be an indication that the uptrend that's been in place for the last year may in fact be over. And so this is a very important pivot from the US dollar perspective. Next year, when we take a look at the Euro FX futures, we can see here that the Euro is creating this flagging formation. We put that blue box up there in the 125 to 126 and a quarter area to being the top end of the retracement zone we felt that the Euro could retrace to. This is as well a make it or break it moment for the Euro as it is in the US dollar perspective. If the Euro here fails to follow through on the upside from here and actually reverses back down, this would be a very a natural place for a new downtrend to begin off of this price level, not necessarily off the price action we're seeing here. We are going into the Jackson Hole Summit, which is coming up this long weekend, and therefore there's going to be a couple of input catalysts that will certainly potentially stimulate a new trend move, whether that is higher or lower. But certainly we're at a key price pivot level from which a new move could get underway. So let's watch how the Euro behaves at this level. Next year, I want to take a look at the 30-year Treasury bond, and here we have a bond market that has actually put in a key bottom right along all the previous highs at around the 145.5 level that were put in the months of January, February, and March. This bounce was material, but we have yet to beat any Fibonacci retracement zones on the upside either, and it would not be uncommon for Treasury bonds to even come back and retest lows a couple times, but the reversal really was on Bernanke's comments during the last set of FOMC minutes, which really has suggested that there's room for further stimulus, which may in fact have already changed the sentiment for many bond traders back into to trading Treasury bonds higher. Really, at this juncture, any short-term pullbacks on Treasury bonds that do not push to a lower low than that 145.5 bottom, then we would be buyers of bonds on that, looking for a return back to the highs. Next year, when we take a look at copper futures, copper really has continued to find overhead resistance along the 350, 355 level where all the highs came in June and July. This is a very sideways range-bound copper market, but it's particularly weaker than a lot of other commodities, which basically suggests that if we see any period of U.S. dollar strength and subsequent weakness in commodities, that we could see copper be one of the leaders to the downside, as it really has not shown any ability to or any strength to be accumulated. And so we'll be watching as this goes. There's going to be a short-term support at around the 340 level that could create short-term bounces. But if we reject off this upper overhead resistance level, return back to the bottom end of the range would be very natural. Next year, when we take a look at crude oil, we see here that this is a market that has had a substantial rising wedge formation that has reached some substantial overhead resistance. There's two storylines. Obviously, crude oil going higher has a lot to do with the unrest in the Middle East and the chances that there could actually be confrontation, which is certainly acting like a stimulus in this. But from a technical perspective, there's no denying that this appears like a rising wedge formation consolidation, and that's in itself could end up having a bearish break. We don't want to imply that the bearish break is underway or is imminent, but these are substantial overhead resistance levels where oil should struggle. In the case of a major geopolitical input variable, we could have a spike back up to 106, 108, 110 on the upside, but that would actually have to probably be stimulated by some sort of external variable rather than that of a natural technical move. Next year, when we take a look at gold futures, gold has made a material breakout on the upside. This is a very interesting wave of price action. While we're not convinced that this necessarily means that the gold consolidation is completely over and there's nothing but upside, but this is the first technical sign that something could be underway. What would be particularly powerful would be if that gold pulled back here and found substantial support especially at the 1625 to 1640 support. If we found support at that level and a brand new breakout occurred, then we could go into a whole number of more bullish scenarios on the upside of gold. It would be in this equal degree materially damaging if gold managed to break down all the way to 1600, as there's a lot of the Joe Schmo public that has already started to buy into the gold reversal, and it would very quickly have everyone run back for the exit doors if this does not follow through. Finally, I want to take a look at the S&P 500, and what we have here is a market that continues to struggle around the 1415 focal point, plus minus a few points, where all the previous highs have occurred. While we certainly cannot rule out short-term spurts, even up to 1440 on the upside, if given a short-term catalyst, we do believe that this is a place where the stock market represents a very poor risk-reward proposition. And in fact, we would be taking defensive actions up here. While we don't necessarily believe that shorting the market here is the most aggressive and appropriate thing, we certainly do believe reducing your risk exposure to the equity markets is appropriate here. When we take a look at the key intermarket observations, we believe that the U.S. dollar represents a very good risk-reward proposition on the short term, as it's pulled back in a primary uptrend. In regards to commodities, gold being in its own class, other commodities out there, the risk-reward is pretty average in what has been predominantly a downtrend over the last year or more. And so we're very more neutral on commodities here. It's a little bit more of a mixed picture. Bonds right now still represent a very good risk-reward proposition on the short term, as there's a primary uptrend that has nicely pulled back and is moving higher. Equally, the U.S. stock market is also in a long-term uptrend, but is at a very poor risk-reward proposition up here. And similarly, global stocks, which have been far more range-bound than the U.S. markets, also still represent a poor risk-reward proposition. So we're more or less suggesting lightening up on equity positions, being very neutral on commodities, and looking for a good risk-reward proposition in bonds and the U.S. dollar. That was your Monday Futures Market Outlook. Thank you for joining me.